Okay, good. So, what was I gonna say? Um, it's another 3 weeks, I think. So we're almost there. So basically, today I'm going to talk about monetary policy. So what the Fed does to move the economy in the desired direction. Next week, I'm going to talk about international trade. And then the last week, I'm going to be just doing a review for the final. And you're going to have the final. The final is going to be available the 9th, the 10th, and the 11th. I know that officially the last day of class is the 14th. So because of that, I'm gonna extend the deadline for the paper to the 14th. Okay, so that way we are official with everything, So nobody can say, well, we finished early. So plenty of time. So don't spend too much time on the paper. I'm an easy grader, and all I want to see is that you've read some articles on a topic of your choosing, and then you understood what the articles were all about. Okay, so you can write about that topic something that makes sense. Okay. Last class, we talk about money creation via the money multiplier. And remember, the money multiplier depended upon something called the reserve requirement ratio. How much cash banks are required to hold on hand in the vault or deposited with the Fed. And the money multiplier was equal to 1 divided by required reserve ratio. So if the required reserve ratio was 0.1 or 10%, then the multiplier would be equal to 1 divided by 0.1, which is equal to 10. So any increase in the money supply, and remember that the only people who can actually increase the money supply, it was the Fed. They have money that is sitting outside of the banking system. When they put it into the economy, and goes into the banking system, we have that positive multiplier. And the Fed can take money out of the banking system and not put it back into the banking system, and it creates a negative multiplier. And we already basically have one tool of monetary policy. So monetary policy is what the Fed does with the money supply and the price of money, which is interest rates, in order to move the economy in the desired direction. So let me just write it down, what monetary policy is. Is what the Federal Reserve, what the Fed does to move the economy in the desired direction. Okay. And obviously, the Fed controls the money supply and controls the interest rates, the price of money. Remember, fiscal policy, which we discussed prior to test number 2, fiscal policy had to do with the government, Congress, and the White House. And they control their spending, and they controlled the taxes. So tax and spend has to do with fiscal policy. Money supply and interest rates has to do with monetary policy. Two distinct policies, two distinct institutions, if you will. So don't confuse the tools of monetary policy with fiscal policy. Completely different. I want you to be aware of that. Folks, do you remember before the pandemic came about? So we're going back to, let's say, last year. What were the number for unemployment? Were they high or low?
Low.
Very low, very low. Unemployment rate was close to 4%. Okay. And the Fed was actually a little bit worried that the economy may be overheated. Okay, we may be doing too good for our own good, and this could lead to inflation. And do you remember what they did to interest rates to cool off the economy a little bit? They did something that hadn't been done in many years. What did they do to interest rates?
They raised them.
They raised the interest rates. They raised the interest rates. Who knew? Who knew that the pandemic was going to come? Maybe they shouldn't have done that, you know? But remember, I told you, economics is more art than science. You don't know what's going to happen. You don't know what's coming around the corner, you know? Maybe it was pandemic this time, you know? I mean, think about it. Who knew? I remember there's a group of investors here in San Diego called the Cohen Group. And they were opening up restaurants like there's no tomorrow, and really nice locations and everything, you know, and they were growing and growing and growing, and they were like a money-making machine. Who knew? You know, you wanted to be part of that investment group. Who knew? Now, what do you think is going on with them? Not too good, folks, not too good. Well, nobody knew the pandemic was going to come and all this stuff. So you never know. You never know. Okay. Well, you already told me one tool of monetary policy is changing the interest rates. And we actually know another tool of monetary policy because it has to do with the reserve requirement ratio. So folks, if the Fed would want to stimulate the economy, to expand the economy, let's say that the economy is hurting and the Fed wants to stimulate the economy, and I'm telling you, is they're going to change the reserve requirement ratio. How do you think that the Fed might change the reserve requirement ratio in order to stimulate the economy, to make more money available in the economy?
Going to decrease?
Decrease, exactly. They would decrease the reserve requirement ratio, which would free up money in the banking system to be loaned out. Because any money that is freed up, it's the reserve requirement ratio goes down. That money now becomes excess reserves that can be loaned out. Okay, so absolutely. So let's talk a little bit about the tools that the Fed has available to pursue monetary policy. And obviously, monetary policy can have only two branches, if you will. Two ways of going about. And one way is expansionary monetary policy, when they want to expand the economy. So the economy may be hurting and they're trying to stimulate aggregate demand by putting more money available in the economy. And hopefully the whole idea is that that money is going to be taken out and spent. The Fed can put all the money to make it available. But if people don't spend that money, nothing happens. Okay, so they can make the money available. They can bring it to your door. But if you don't take that money and you don't spend it, there's no impact on the economy. So monetary policy can be expansionary contractionary. So when the economy is hurting, the Fed is going to pursue expansionary monetary policy. And when the economy is doing really, really good, it's overheated, then the Fed pursues contractionary monetary policy. And it's easy to remember the tools, because if you know what are the tools for expansionary monetary policy, then you also know the tools for contractionary monetary policy. It's exactly the opposite. Okay, the same like we had with expansionary fiscal policy. Well, contractionary fiscal policy was exactly doing the opposite, the government. Now here is the Fed. So let's talk about expansionary fiscal policy, and then you also know immediately what contractionary fiscal policy would be. So you already told me one of them, and one tool of expansionary fiscal monetary policy, I'm sorry, is to lower the reserve requirement ratio. I can also tell you that this is the least used tool that the Fed employs as monetary policy. So the Fed doesn't change the reserve requirement ratio very often, so it's the least used tool. Okay. But it can be used. It can be used. They want to expand, they want to put up more money available in the economy, they lower the reserve requirement ratio, that frees up money so that the banks loan out that money. Again, the problem is that while they make the money available, when the economy is this monetary policy, this type of monetary policy is pursued when the economy is stumbling, when the economy is going into a recession, when we have bad times. And the problem is that when we have bad times, while the Fed can free this money to be made available, to be loaned out, you have on one hand banks that at that time they are wary about making loans because times are tough. That's when people are losing their jobs. That's when businesses are going out of business. So it's not a time to loan out money because they may never see it paid back again. So one, you have the banks, they don't want to loan out that money. And two, nobody borrows money when times are tough. So the Fed may make the money available, but it's not necessarily a situation that is going to be taken advantage of by businesses or individuals. Okay. All right, so that's one tool of expansionary monetary policy. Another one would be, like you told me, lower the interest rates. So when times are good, you raise the interest rates. When times are tough, you lower the interest rates. That makes it cheaper for businesses, for individuals to borrow money and spend it and put it to work. Because for money to be money has to be spent. It has to be in the economy doing stuff. If it's just sitting under my bed or it's sitting in my pocket but it's not buying anything, then there's no impact in the economy. Okay, so for money to be doing something, it has to be spent. And all the Fed can do is make the cost of borrowing money cheaper. And hopefully what they're doing is they're hoping that businesses and individuals will take advantage of the lower cost of borrowing money and they will take it and spend it. Okay, so they can lower the interest rates. And they, in general, they lower the short-term interest rates. So it doesn't necessarily mean that you're going to see mortgage rates going one way or another, but it's short-term interest rates. So if you are thinking about buying a car and need a loan, a 5-year loan or 6-year loan, well, that's going to help you. That's going to help you. It's going to make your decision a little bit easier because it's going to be cheaper. Okay, so those type of loans. So the loans that are meant to, buy furniture or buy brand new kitchen appliances and stuff like that. Those type of purchases will be impacted, or for businesses to whether to buy a new piece of machinery or not. And one more tool that the Fed has available is to buy and sell or sell government bonds. This is called open market operations. So okay, now let's see whether the Fed buys or sells government bonds. Okay, now and it's called open market because the Fed buys or sells those bonds on the open market. It's not something that is done in secret or anything like that. It's on the open market. So keep in mind, to determine whether the Fed is going to buy or sell bonds, remember that government bonds are pieces of paper which are IOUs, which the government, the federal government, not the Fed, not this Fed, but the federal government, Congress, White House, that's money that the government borrows, okay, in order to spend, to increase the spending. So if they want to increase the spending, they kind of got to come up with some money. Well, where are they going to get this money? They're going to get it from us, but they're not going to get it from us in form of the higher taxes, because that would offset the economy. You have increase in spending from the government, you have decrease in spending from us because we have higher taxes. So that's not a smart idea. So they're not gonna increase the spending by increasing taxes on us, but they're gonna increase the spending by borrowing money from us, from whoever, from investors. Okay, and hopefully the whole idea is that that money would not have been spent on anything else. So when the government borrows that money and puts it to work and starts spending it, that money would not have done anything else but for the government spending. Okay, so you're not offsetting something else. Remember the crowding out effect? You take money from the private sector and you increase public sector, but there's an offsetting effect. So hopefully when they borrow money, this money would not have been spent on something else. So now you have an increase in aggregate demand. So now the government borrows money, and all those people, all those investors who bought those government bonds, now they have those pieces of paper, which tells them that they're gonna earn some interest and they're gonna get eventually their principal back, right? Whenever you borrow money, you're gonna get your money back plus some interest. So those investors, they're looking at the government giving them back some money in the future, the principal that they paid plus some interest. Now, they are holding those pieces of paper. And guess what? Those pieces of paper, they cannot be spent out into the economy. Okay, so you have a government bond, but you cannot buy with it anything. You cannot go to a car dealership and buy a car. You cannot buy a refrigerator. You cannot buy anything with those government bonds. So what's going to happen now is the Fed is going to come in and is going to say, well, you know what? We are willing to purchase those government bonds from you. And what they're going to pay for those government bonds, what they're going to pay with, you tell me. What do you think that the Fed will pay for those government bonds with?
Dollars.
Exactly, with money, with dollars. So now suddenly we have a new influx of money into the economy. So the Fed is sucking out all those government bonds, which cannot buy anything in the economy, and they're paying for those government bonds with dollars. And their hope is that all those investors when they get the dollars, what will they do with those dollars?
Spend them.
Spend it. Spend it. Exactly. You want to stimulate aggregate demand. You want to stimulate spending. Okay. So here's the economy. And the Fed is pursuing expansionary monetary policy. What will they do with open market operations? Buy bonds on the open market or sell bonds on the open market? You tell me.
Buy.
Buy, exactly. They will buy bonds on the open market. So with expansionary monetary policy, they buy bonds and dollars are going into the economy. And hopefully those dollars will be put to work. Again, if the Fed buys bonds on the open market and they pay for those bonds with dollars, and the investors who got those dollars, they're taking those dollars and putting them in their pockets and doing absolutely nothing with them, what is the impact of monetary policy?
Nothing.
Zero. Exactly. Nada. Nothing. Money has to be spent. Okay. Now, folks, so here with open market operation, we're going to sell, they buy bonds. So let's review contractionary monetary policy. Contractionary monetary policy is exactly the opposite, is when the Fed wants to cool off the economy. Well, they can raise the reserve requirement ratio. Less money will be available to be loaned out. They can increase the interest rates. It's going to make it more expensive for us to borrow money, and fewer of us will borrow money, and therefore will stifle some of the spending. Or they will sell bonds on the open market. And when they sell government bonds, they sell the bonds to investors, and investors are paying for those bonds with
Dollars.
dollars. Exactly. They're not paying them with, chewing gum. So with contractionary monetary policy, dollars are going out of the economy. The dollars are going to the Fed. And the Fed is not doing anything with those dollars. So it sucks the dollars out of the economy. And now bonds are going to the investors. And remember, the investors cannot buy anything with those bonds. So therefore, the money that could have been spent is actually transferred into bonds, and those things cannot be spent. So therefore, it takes away the dollars which could have been spent. So when the economy is overheated, it takes the dollar out of the economy. Okay? So the whole idea is when the economy is hurting, you want to pump money into the economy. You want to make it cheaper for money to be borrowed and spent. And when the economy is doing very well, too good for its own good, then they take the money out of the economy so that spending goes down and it cools off the economy. Now, of course, I think that most of us are more concerned with a situation where the economy is doing poorly, rather than being concerned with an economy that is doing too good for its own good. Okay, so we're really not that concerned with an overheated economy. Most of us would say, just leave it alone, leave it alone. Okay. times that are too good are never too good, but we are more aware and more fearful of bad times, times when people are losing their jobs, when we have recessions. Unfortunately, folks, monetary policy doesn't work very well when the Fed pursues expansionary monetary policy. On the other hand, when the Fed pursues contractionary monetary policy, that works quite well. So if they want to screw up the economy, they're pretty good at that. But if they want to help the economy, they're not very good at that. Economists, sometimes they say that contractionary monetary policy is like pulling on a string. It works very well. On the other hand, expansionary monetary policy is like pushing on a string. Doesn't work very well. Okay. So this is unfortunate, but in general, you can understand how come expansionary monetary policy doesn't work very well. Because when we are in a recession, people don't want to borrow money. Banks, they become more risk averse. They don't want to lend the money. That's not a good time to lend the money. That's not a good time for us to borrow money. So when the economy is in bad shape, expansionary monetary policy is not very successful because we're doing exactly the opposite that we ought to be doing. I mean, it's perfectly understandable that people tend not to spend money, not to buy cars, not to buy new kitchens and stuff like that when times are tough. Okay. And it's also understandable that banks don't want to lend money when people may lose their jobs, when businesses may close down. That's not a good time. That's the time when you become more and more cautious. Okay. So all the Fed can do is make the money available or make it available cheaper. But if nobody does anything about it, nobody takes that money and spends it, then that policy is going to be rendered rather impotent. It's not going to do anything. Okay. All righty. At this point, I think that we're basically done with monetary policy. Any questions that you have? So as long as you know expansionary monetary policy, the tools of expansionary monetary policy, you also know the tools of contractionary monetary policy, because it's going to be exactly the opposite. Okay. So remember, when the Fed is pursuing expansionary monetary policy, they're trying to get aggregate demand to shift to the right. They're trying to increase the spending in the economy. Okay. In aggregate demand, if the spending increases, then aggregate demand will shift to the right. And that's going to close that recessionary gap. Okay, so let me shut this off.